Trade between Canada and the U.S. is fairly balanced. Canada and the U.S. has had trade relations that go back decades. U.S. and Canada are among the world's most integrated bilateral trading partners. And so the arrangements that are currently in place between the two countries are mutually beneficial to the U.S. and Canada. So we expect, because going into any negotiation, the trade relationship between Canada and the U.S. is fairly balanced. We don't foresee major rethink of the trade flows between Canada and the U.S. We would want to presume ahead of time what those negotiations might look like, what the discussions might focus on. But I would say that going into any talks between the two countries, that we have two countries which have heavily integrated economies that have invested quite a bit in shared supply chains, and that benefits both countries. Our current outlook on the Canadian sovereign rating is stable. Canada continues to be rated AAA, and it has a diversified economy, and those are some of the dimensions that support the current rating. Quite a bit is on the agenda. And depending on which initiatives are implemented by the new U.S. administration, some of those initiatives will potentially support U.S. GDP growth. If we think about the possibility of lower corporate tax rates, new infrastructure spending, deregulation in some areas of the capital markets, these could in fact benefit the U.S. economy. And because Canada is one of the U.S.'s largest trading partners, there could be spillover benefits for Canada in all of that. Any initiatives that support global trade and remove barriers to trade, we think can have positive economic impacts. Canada has long-standing trade relations with Europe, and the new agreement will help to lower some of the remaining tariffs in place between Canada and Europe. So in that sense, the new trade agreement with Europe, we think, will help Canada's economy. So if we take a step back and think about what some of the major criticisms were focused on, one in particular was the fact that it was difficult to understand where the rating agencies were coming from sometimes. In some instances, the methodologies that we use to assign ratings were described as opaque, not as clear as they could have been. And S&P Global has certainly done quite a bit of work in this area to try to enhance the transparency of our methodologies and provide much more detail and background that help ratings users understand the assumptions that are driving the rating opinions that we publish. So one of the risks that we have been monitoring for some time is the impact that any changes to global trade policies affect economies and how that sort of translates into specific impacts for borrowers within the four regions that we focus on with these conversations. So how would car companies in Europe or the U.S. be impacted by the imposition of new trade tariffs? So yes, we see the potential for companies within those industries to be impacted. We look at those risks. Our rating analysts look at those risks when they review companies within their portfolio of credits. But we also have our team of economists and fixed income analysts looking at demand for autos, as well as global trade capital flows. And we bring all of that analysis together in our assessments.